How one man built a banking empire. From nothing, intro. Back in the 1980s, the credit card industry was a monolith. It was a giant, lumbering beast operating on a simple but deeply flawed idea that every customer is the same. It didn't matter if you had a perfect credit score or were one late payment away from disaster. You got the same card, the same interest rate. The system was dumb, inefficient, and left billions of dollars on the table while shutting out millions of potential customers. But one man, a consultant with zero traditional banking experience, saw the fatal flaw in this one-size-fits-all model. He believed everything the big banks knew about credit was wrong. And with that single belief, he was about to build a multi-billion-dollar empire from nothing, outsmarting the entire industry along the way. This is the story of how Richard Fairbank launched a revolution called Capital One. To really get what a huge shake-up this was, you have to picture banking in the 80s. Credit cards were finally going mainstream. The magnetic stripe made paying for things a breeze, and the two major networks, what we now know as Visa and MasterCard, had connected banks all over the country. But under the hood, the business model was incredibly primitive. Banks operated on a carpet bombing strategy. They'd blast out identical credit card offers to the public with no real way of telling the good risks from the bad ones. It was a total scattergun approach. This was partly because of old usury laws that put a cap on interest rates, which made it unprofitable to lend to anyone who wasn't a perfect borrower. This created two huge problems. First, millions of perfectly creditworthy people were denied cards just because they didn't fit the cookie-cutter mold. Second, the banks were leaving a fortune on the table. They were offering the same deal to a high-earning doctor and a recent college grad with no credit history. The whole system ran on averages, not individuals. The industry was profitable, sure, but it was just waiting to be broken. The guy who would break it wasn't a banker. He was a young consultant named Richard Fairbank. After getting his MBA from Stanford, Fairbank landed a job at a consulting firm. And in 1985, he and his colleague Nigel Morris were assigned to a regional bank. As they sifted through the data, they didn't just see numbers. They saw a colossal market failure. Fairbank realized the one-size-fits-all model wasn't just a quirk. It was the industry's Achilles heel. His big idea was this. What if you use data and technology to treat every customer as an individual? He believed that with enough statistical analysis, you could precisely measure a person's credit risk. And if you could measure the risk, you could price it. Instead of one interest rate for everyone, you could create thousands of different products. High-risk customers might get a card with a higher interest rate and a lower limit, while low-risk customers could get better rates and perks. They called it the information-based strategy, and it would become the founding principle of Capital One. Fairbank didn't see himself as building a bank. He was building an information-based marketing company that used data to find profitable customers everyone else was ignoring. Having a brilliant idea is one thing. Convincing the slow-moving world of banking to bet on it is another entirely. Fairbank and Morris took their pitch to over 15 major banks. Every single one of them, including giants like Citibank and Wells Fargo, turned them down. They were stuck in their old ways, focused on brick-and-mortar branches and mass-market ads. This data-driven surgical approach just seemed bizarre to them. But Fairbank didn't see the rejections as failures. He saw them as free market research. Each no gave him more insight into the industry's blind spots. Finally, in 1988, their radical idea found a home. A regional bank in Virginia named Signet Bank was willing to take a gamble. Signet wasn't a Wall Street powerhouse, but it was hungry for innovation. They agreed to fund Fairbank and Morris, setting them up as their own little credit card division to run their experiment. This was their lab, and they were about to invent the future of finance. By the early 1990s, the experiment wasn't just working. It was a spectacular success. The division was so profitable and growing so fast that it was outshining its parent company. It was clear it had to become its own thing. In July 1994, Signet announced it would spin off its revolutionary credit card division into a new independent company. They initially called it Oakstone Financial, but just before its public offering in October 1994, it was rebranded with a name that better fit its grand vision: Capital One. Richard Fairbank was named CEO that year. When the spin-off was officially completed in February 1995, he had gone from a consultant with a wild idea to the head of a publicly traded financial institution. From day one, Capital One was a different animal. It had no branches. Its headquarters wasn't on Wall Street, but in suburban Virginia. Its most valuable assets weren't vaults full of money, but servers full of data. Now, free from the constraints of a traditional bank, Fairbank was ready to unleash his information-based strategy on the entire industry. So, how did this actually work? In short, it was mass customization on an epic scale. While competitors saw one big market, Capital One saw thousands of tiny micro-markets. Using software they built themselves, they would test tens of thousands of different product variations every year. They'd try a card with a 17.9% interest rate on one group of people and a 17.8% rate on another. They'd test different fees, different credit limits, and different marketing messages. Every single response, or lack of one, was a data point that fed back into their models, constantly making them smarter. This test-and-learn method allowed them to offer the perfect product to the perfect customer with scientific precision. This led to one of their killer innovations, the balance transfer. Capital One saw that millions of people were stuck paying high interest rates at other banks. So they targeted these customers with an irresistible offer. Transfer your balance to us, and we'll give you a super low introductory teaser rate. It was a genius move that other banks, with their rigid one-size-fits-all model, couldn't match. Customers flocked to the better deals, and Capital One's growth went into overdrive. The results were mind-blowing. By 1997, just 2 years after its IPO, the company was already serving 9 million customers. Fairbank's vision didn't stop at credit cards either. He saw his data-driven strategy as a weapon he could use in any industry. In 1996, Capital One went international, expanding into the UK and Canada. Then, in 1998, it jumped into the auto loan market by acquiring Summit Acceptance Corp, applying the exact same principles of data-driven risk management to car loans. Each new venture proved the core strategy. Use data to find the profit in places the competition had missed. By the early 2000s, Fairbank saw a new risk on the horizon. Capital One was a monoline company. Nearly all its revenue came from credit cards. To survive and build a lasting empire, he needed to diversify. He set out to transform Capital One into a full-service bank. The pivot started in 2005 with the roughly $5 billion acquisition of Hibernia National Bank in Louisiana. This was Capital One's official entry into retail banking. Hot on its heels, they bought North Fork Bank in New York for $13.2 billion in 2006 and Chevy Chase Bank for about $520 million in 2009. These weren't just purchases. They were strategic moves to get physical branches, a stable base of deposits, and a direct line to everyday banking customers. But the real game changer came in 2012, when Capital One bought the online banking giant ING Direct USA for $9 billion. This instantly gave them a massive national direct banking presence. It was rebranded as Capital One 360 and became the digital cornerstone of the company. In less than a decade, Fairbank had taken Capital One from a credit card specialist to one of America's 10 largest banks. Today, Capital One is a Fortune 500 financial giant. And Richard Fairbank? Remarkably, he's still the chairman and CEO, one of the very few founders still leading a major American company. His official base salary? It's been $0 since 1997, tying his pay directly to the company's performance. The information-based strategy has now evolved into an AI-first mission. The company uses machine learning for everything, from the virtual assistant Eno that watches for fraud to the CreditWise tool that helps you manage your credit score. And the empire keeps expanding. In February 2024, Capital One announced its biggest move yet, a massive $35.3 billion deal to acquire Discover Financial Services. The deal, which is expected to close in late 2024 or early 2025, still needs regulatory approval. But it represents a tectonic shift in the payments world. It not only combines two huge credit card companies, but also gives Capital One its own payment network, putting it in direct competition with the titans of the industry, Visa and MasterCard. It's arguably Fairbank's boldest play yet. The story of Capital One is really the story of a single powerful idea. It's proof that an entire industry, no matter how powerful, can be flipped on its head by an outsider who sees the one thing that everyone else missed. Richard Fairbank had no money and no banking experience. What he had was an insight that in the modern world, information is the most valuable currency there is. He looked at the banking industry's dumb, one-size-fits-all model and saw its fatal flaw. By exploiting that flaw with data, technology and relentless testing, he didn't just build a credit card company. He built a diversified, technology-driven banking empire that is now poised to challenge the very foundations of the global payment system. All because he asked a simple question about the piece of plastic in your wallet.